Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we're diving into Pilgrim's Pride's Q4 2025 results. And, the way the market reacted, it tells a really interesting story.
All right, let's jump right in with the market's immediate verdict. The stock dropped over 4% in after-hours trading. Now, here's the kicker. This happened even though they beat on revenue. So that really sets up the big question for our breakdown today. What on earth did investors see that they didn't like?
So how do we get to the bottom of this? Well, we've got to look at the headline numbers. And what you see is this classic Wall Street story, a real tale of two tapes. You've got strong revenue on one hand, but weakening profitability on the other. And here's where you see that disconnect in black and white. Revenue came in hot at $4.52 billion, a really nice beat. But then you look just below that line, adjusted earnings per share, a miss. And the big one, that adjusted EBITDA margin, which is just a fancy way of saying how profitable they are, it got squeezed. I mean, it went from 12% a year ago all the way down to 9.2%. That's a huge drop. So yeah, this slide just nails the core problem, right? All that good news on the sales front was totally wiped out by the bad news on the profit front. In the short term, the market's basically a voting machine, and it voted with its feet, focusing squarely on that margin pressure. So the billion-dollar question is, what's management going to do about it? Okay, let's get into their game plan. Management's playbook seems to have two main pillars. First, they're leaning hard into the idea that chicken is affordable, a value protein. And second, they're pouring money into their higher margin branded stuff to try and get away from the crazy swings of the commodity market. This quote from the earnings call, it really says it all. Management thinks they have this huge tailwind at their back. I mean, with beef prices through the roof, they're betting that people are switching to chicken not just because they like it, but because they have to. It's about making the household budget work. And here's some proof that the strategy's actually paying off. Their Just Bear brand, it just crossed $1 billion in annual retail sales. That's not just some number on a page, it's a massive milestone. It proves they can build a premium, high-margin business that can cushion the blows from the volatile commodity side of things. So, to boil it all down, here's the plan. Number 1, keep growing that branded portfolio. 2, pour money into getting bigger and more efficient. 3, really solidify those key customer partnerships. And 4, spread their bets geographically, especially looking at a high-growth market like Mexico. It's a pretty clear 4-part strategy. And listen, they are absolutely putting their money where their mouth is. That 2026 CapEx guidance, it is a major step up. It signals a year of some really heavy investment. They're basically retooling the whole business right now, making a bet that a little short-term pain is going to lead to much better, more stable profits down the road. But of course, a huge investment plan like this, it's never a sure thing, right? It comes with risks. And the analyst Q&A session on the call was super revealing. It really brought a few key concerns to the surface that are clearly on investors' minds. So here's what's keeping investors up at night. First, can they stop the bleeding on margins? Second, what about Mexico? It was a weak spot this quarter, so how are they going to handle that volatility? Then there's Europe. Is demand over there going to hold up? And, the elephant in the room? Is this massive $900+ million spending spree actually going to pay off with a real return?
All right, so that brings us to the final breakdown. We've seen the good, the bad, and the ugly in the numbers. We've heard management's ambitious plan, and we know the risks. So, where does that leave us? What's our call on the stock as we head into the next quarter? Look, heading into their next report, we're going to be watching 3 things like a hawk. First and foremost, margins. We need to see some sign that they're stabilizing or even better, improving. That's a must. Second, we need to see that branded products like Just Bear keep up their momentum. And third, we'll be looking for any early hints that all this capital they're spending is actually starting to make them more efficient. So with all that in mind, our rating on Pilgrim's Pride is market perform. You've got a really compelling story on the bull side, right? This powerful demand for chicken and real growth in their high-margin brands. But that's completely canceled out by the current pressure on their profits and the huge risk that they might not pull off this massive investment cycle perfectly. The whole story just feels perfectly balanced on a knife's edge right now, and that's why our rating is what it is. Now for our trade idea. Given this huge tension between the great sales story and the not-so-great profit story, a long volatility play could make sense here. What does that mean? Well, instead of picking a side, betting whether the stock will go up or down, you're basically betting that it's going to make a big move in either direction. You're betting that this uncertainty is going to get resolved one way or another, and soon. A common way to play this is with an options straddle, which profits from a big swing.
And as always, remember, this is not financial advice.